In the last video, we saw how $1 can multiply inside the banking system. But that raises a deeper question. If money can expand like that, who actually gets access to it? Because not everyone benefits equally. Some people get money easily. They borrow at low interest, they're offered better terms, while others struggle just to get approved at all. So what decides who gets access? The answer is simple: credit. At its core, lending is about one thing: risk. When a bank lends money, it's not doing anything mysterious. It's asking a basic question: what are the chances we get this money back? That's it. Every loan starts there. And not all borrowers look the same through that lens. Some borrowers walk in with something powerful: assets. Assets are things that hold value: property, a business, investments, even vehicles. Anything the bank can point to and say, this is worth something. When a borrower has assets, the bank's risk drops, because if the borrower fails to pay, the bank isn't stuck with nothing. It can claim those assets. This is called collateral, and collateral changes everything. With collateral, the bank has a backup plan. Even if things go wrong, the loan isn't a total loss. So, borrowers with assets can usually borrow more money. They can borrow it at lower interest rates. They get longer timelines, better terms, more flexibility. But what about borrowers without assets? From the bank's perspective, they're riskier. There's no safety net, no clear fallback, so the loan looks more dangerous. And that means smaller amounts, higher interest rates, stricter approval standards, or sometimes no loan at all. So right away, the system creates a divide, not based on effort, not based on how hard someone works, but based on what they already have. Now here's where things start to accelerate, because access to credit doesn't just help once, it compounds. Imagine two people starting in different positions. Person A has assets, person B does not. Person A can borrow at low interest, so they take out a loan. They invest it. Maybe they buy property. Maybe they expand a business. That investment produces income. That income helps them pay off the loan. And once the loan is paid down, they now have more assets, which makes them look even safer to lenders. So they can borrow again, often more than before, at even better terms. And the cycle repeats. Assets lead to credit. Credit leads to investment. Investment leads to more assets. This is the wealth snowball. At first, it doesn't look dramatic, but over time, it builds momentum. Now compare that to person B. Without assets, borrowing is expensive. Interest rates are higher, loan sizes are smaller, opportunities are limited. So instead of using debt to build wealth, they're often using it to survive. More of their income goes toward interest, less goes toward saving, less goes toward investing, and that slows everything down. So while one person's money is accelerating, the other's is barely moving. Not because one is smarter, not because one works harder, but because access is different. Now let's zoom out, because this dynamic doesn't just exist between individuals. There's a hierarchy of credit across the entire system. At the very top are governments, especially large, stable governments. They can borrow at the lowest rates in the world, sometimes close to zero. Why? Because they're seen as the safest borrowers. They're large, they're predictable, and they have enormous backing behind them. Below governments are major corporations, big companies with steady cash flows and valuable assets. They also borrow cheaply. Then come banks and large investors. They sit close to the financial system itself. They can often access money before anyone else. Below them are middle-class individuals with strong credit scores, stable income, some assets, a solid track record. They can borrow, but at higher rates. And at the bottom are high-risk borrowers, people with low credit scores, little or no assets, unstable income. They face the highest borrowing costs, if they get access at all. So the system isn't flat, it's layered, and each layer determines how expensive money is and how available opportunities are, which means the same dollar does not cost the same for everyone. Now this raises an obvious question. Why does the system work this way? Is it designed to be unfair? The answer comes back to risk. Banks aren't trying to reward some people and punish others. They're trying to be predictable. They need to limit losses. They need to avoid defaults. They need to survive downturns. Lending more to safer borrowers helps stabilize the system. It keeps banks solvent. It keeps credit flowing. But there's a side effect. Those who already have access get more access, and those who don't face higher barriers. Over time, that gap can widen. Not suddenly, not dramatically, but gradually, quietly, systematically. And this is the key idea. Credit is not about need. It's not about effort. It's not about fairness. It's about risk. And risk favors people who already have assets. So if credit decides who gets access to money, there's one more question we have to ask. Because most people don't earn money through investments. They don't earn it through assets. They earn it through wages. So what determines wages? And what happens if wages don't keep up with inflation? That's next. After all, we're just asking, aren't we?